Today's guest is Dave Van Horn. Dave Van Horn is president at PPR, the note company, an operating entity that manages several funds that buy, sell, and hold residential mortgages, both performing and delinquent. Dave has been in the real estate business for over 25 years, starting out as a realtor and contractor and moving on to everything from fix and flips to raising private money. PPR has been in the mortgage advisory and fund management business since 2007. It acts as an advisor to several investment funds that acquire distressed residential debt nationwide. PPR's funds manage first and second mortgages as well as REO properties. Dave's goal is to bring investors unique opportunities to build wealth and create passive income through investing in real estate notes. Most recently, Dave wrote the book on real estate note investing, teaching others how to use mortgage notes to passively and massively increase your income. So today's learning objectives are to understand the basics of note investing, how to build wealth like a bank, buying your first property purposefully, power of leveraging connections, the natural progression of capital, best investing strategies, and debt versus equity. So Dave, welcome to the show. How are you doing today?
Wow, that's a lot of stuff.
Yeah, sorry. Yeah.
No, I'm doing great. How about you?
I'm doing well. Just excited to have you, and really, I feel blessed that I reached out to you, and you're more than happy to kind of help me out with a couple of my passions, and hopefully we can provide some value to listeners today. So.
No, I love the whole book interview thing. I read a lot of books, and it's one of my daily morning rituals. So
it's good.
Can relate.
Yeah. Yep. All right. So let's start with the introduction notes and how they work.
Well, a lot of times when I'm speaking somewhere, or I'm talking to a group, I kind of introduce the idea of either asking the audience what their first note was, or I'll ask the audience who in here is in the note business. And at first, no one really raises their hand. And then a lot of times I'll start by asking questions of, well, do you know any hard money lenders? Or how many people in here have a credit card? Or how many people have a student loan? Or how many people have an auto loan or a mortgage? And what they quickly realize is most of us are all in the note business. Mm-hmm. We just never thought about it. And, I was actually talking to my son about this because we write a lot of articles, and I was like, we should do an article or something about how people go through life and financing activities just happen to them. And then there's a select group of people who actually master finance or master financing and use it as a tool, whereas everybody else kind of lets it happen to them. They just go through life ignoring it. Meanwhile, banks are, they're making money off you every which way, and financing impacts your cost of insurance. It impacts all these things in your daily life that everybody just ignores. They ignore the impact of their credit score. They just go through life, and financing happens to them or at them, as opposed to harnessing it and actually learning it and using it as a tool,
Yeah, no, definitely. So let's talk about that strategy, building wealth by being like the bank. What does that look like?
Well, I think a lot of us are, it's a huge marketing machine when you think about banking. And for me, you can tell from the stories in the book where, I was in college and I took money in banking, and I never thought of the impact it would have on me. It's kind of, it's probably not a great analogy, but you'll see like Steve Jobs took calligraphy, right? And all of a sudden it's in Apple products, right? Well, it's kind of the same for me, right? Here I am in this business where I'm really disruptive to the banking business and even the financial advisory business. We're trying to create a platform where people can invest 24 hours a day in a Wall Street product with no middlemen on your cell phone, right? Like that was unheard of a few years back, right? You couldn't, you would have to go to your advisor and he would recommend, that kind of thing. And look how disruptive we're being right now. So, the fact that banks have been marketing to the public to park your money, be safe, when they're moving money constantly. They're not parking any of their money. In fact, they're leveraging their money and they're moving their money, and they're telling you to park their money with them. And if you park your money with us, I'll give you a free pen or a free, notebook if you open a checking account. One of the biggest jokes in banking is that there's a free checking account. It's really not free. You're giving up a huge opportunity cost of your capital to the bank that they're utilizing. In fact, they're re-leveraging it. So,
Awesome.
so I'm introducing the idea of, hey, why not start to think like the bank, be like the bank, change your mindset, alter some of your activities, and you could quickly incorporate a lot of the strategies to, eliminate and pay down debt quicker, ways to just be like the bank and become the lender sometimes. And you can actually do the same thing and make a lot of money that way. And if you really think about PPR, my goal is to be $1 billion under management in less than the next 10 years. And, I'm doing this with OPM, other people's capital. It's really, I wish I had $1 billion, but I don't. And the fact that I can put that all together and make that happen is pretty powerful, right? Being the bank, thinking like the bank.
Definitely. Yeah. No, I feel like that's the ultimate goal in investing. It's kind of, borrow other people's money now, and then hopefully one day as an investor, you do reach that point where, hey, I'm putting my money to work as opposed to, putting other people's money to work. So was that kind of hard, first getting out there, or there's a point during your career where you started using your own capital to kind of grow, on itself by lending it out?
Well, I think even in the book, I try to give this general overview of just banking in general, just lending in general, just finance in general, just notes in general. The note world's a vast world. It's $1 trillion industry, and people don't even know it's happening, right? It's like, so I think in the beginning, even for myself, I'm this young guy out of college. I'm just trying to figure it all out, trying to figure out life. Where am I going? What am I doing? Who am I? What do I want to be? How you're trying to find yourself and all that good stuff. But then over time, I think the first real advantage of thinking about leverage and thinking about, arbitrage was when I took a real estate investment class towards my broker's license. I was just a regular realtor, so to speak. And I was working in construction in the day and becoming a realtor at night. And I was taking classes. And the one class, the teacher was talking about utilizing credit cards to purchase houses. And that never had occurred to me. And at the time, cash advance checks were relatively new. And there was almost no fees at all. Today, that's different. And I don't know that I would use this technique today. In fact, I would just use private money or hard money. But at that time, it was like, oh my gosh, I can write myself a credit card check and deposit it in my account. I never thought of that, right? And I never thought about using, the bank's money to go buy a property, because I knew how to find deals through the MLS, and I knew how to renovate deals because I was in construction. So the missing piece for me was the capital. I had no capital. I was just this, blue collar kid, that just didn't have a lot of resources. And then that was the missing link. And then, I probably got my first 10 or 12 houses that way, where I'd buy a house with credit cards, fix it up with credit cards, move a tenant in, refinance, pay the credit cards off. And then I accumulated, quite a bit of property. Eventually I had 40 places. And then next thing you know, property values jumped up. Very little pay down. It was mostly an increase, appreciation thing that happened along the way by, I don't want to say by accident. I guess you make your luck some ways. But, it appreciated. Next thing you know, I have a couple million in equity. And, it's like, where'd this come from?
Yeah.
And I started using lines of credit and arbitrage again. I'm borrowing money at 3 and 4% and lending it out at 15 and 18 with points.
Okay.
Well, that's huge difference of arbitrage. If you get $2 million in equity and you can tap even 80% of it, that's 1.6 million. And you can make a 10% spread between if you're borrowing at 4 and you're lending at 14, that's a 10% spread. You're making $160,000 a year. Well, that was more than most of the salaries I had up until that point. Here I can make $160,000 a year safely and passively by lending to other contractors that were friends to do their rehab projects. And if you're only lending 65% loan to value, it's a very safe deal. Plus, I could renovate property if I took it back. So it was in my wheelhouse. Now, not everybody has my advantages that I had, being a realtor and being a contractor. Not everybody's in that position. But it's really, you could still focus on what you're good at, and hire the people that you're not good at. I'm not good at everything. There's a lot of things I'm terrible at. So
Yeah. Awesome. I still think that's amazing that you bought your first house with a credit card. I just hear that, and it's just awesome. But I love your creativity. You said you had everything else besides the capital, so you went out and you did what you did to make it happen.
Well, I was a loner too. At that time, I didn't really network very well, and I didn't know much about networking at that stage. I was still young. I was probably in my upper 20s, and I was coming from the real estate world, and I networked with other realtors, but I didn't really network with investors, like real estate investors. And I was probably in my early 40s before I did. So I had probably already owned 10 or 15 houses by the time I started joining real estate investor groups, almost like meetups today, whether it was a RIA group or that type of thing. And then I really started to click for me. So it's back to what I tell people starting out today. If you want to get good at anything, you want to get educated in the space, you want to network with people doing it, and if you can find a mentor or coach to accelerate it, more power to you. And it could be any field. It doesn't necessarily have to be just real estate. It's almost anything like that. And I was missing a couple of those pieces for a while,
Okay. Yeah, and you put great emphasis on the power of leveraging those connections and knowledge in the book. So how do attending those meetings and, sharing, discussing ideas and workshops, shape your career as you went over the years?
Well, I found that career. So I went to the first RIA group meeting, and I was looking for financing, and I found it before I even got inside. There were vendor tables out front, and it was actually it was a lender out of Pittsburgh who was turning me on to all this creative financing strategies of, basically an investor-friendly lender. Mm-hmm. Well, I had never met one of those. I didn't know they even existed. And here I am, a realtor, right? I'm in my own little bubble. And I never realized, this guy had me re-leveraging all kinds. He was finding me capital everywhere. I was like, oh my gosh, this is unbelievable. And then even when I joined the group, not only am I hanging out with other people that are in the same issues that I have, but the other piece was I was introduced to notes, and they would have like a speaker come in and then on a Saturday workshop. And the very first person I saw on a Saturday workshop was Jimmy Napier, who wrote the book Invest in Debt. And of course, nothing resonated for a long time. I was in renovation mode and accumulation of property mode and didn't really think about the note space for a long time. But I started seeing more and more people talking about notes, whether it was Donna Bauer and Pete Fortunato and all these different, Jack Millers. And I would just sit in these seminars, not necessarily buying courses or anything, just absorbing. And over time, I started borrowing private money to do my projects. And then I said, well, this is really cool. I can lend money to do this as well. So not only was I a borrower, I became a lender. And at one point I was, an agent at a RE/MAX, and I was doing property management, and I owned a title company and doing all kinds of activity through my real estate business. I talk about in the book, multiple streams of income. I saw Robert Allen speak and read his book. I was like, well, how can I incorporate more channels of what I do every day? Because we do activities every day where all these people are making money off us, and we never think about, well, that could be me making that extra company or that extra vertical. And a lot of times we leave money on the table. So I started doing some of that. And then at one point I'm doing property management, and I'm managing over 100 units for friends. And I was mostly selling to real estate investors at the time. But then I was also doing lending, and the lending was just so easy. And compared to my regular activity. And as a realtor, I started to become like a full-time inspector, inspecting HUD houses and home inspections and rental properties. And then I also was in court. I would go to court at least once or twice a month, and then it became more and more frequent as the portfolio grew that I was managing. So I'm in court all the time. I'm inspecting property all the time. And I'm really not getting paid that well for that, And I'm like, is that the best use of my time? Or over here, I could just be a lender, and I don't have any of that nonsense most of the time. I mean, sure, you could take a property back, but it's rare. I mean, so when I started looking at simplicity, as I got older, and hopefully wiser, I started to gravitate towards real estate investment vehicles that were less, tenant intensive or maintenance intensive, almost like I'm a not tired landlord, but more like a smart, lazy landlord kind of thing, where, hey, if I have an office building, my tenant's only there from 9 to 5. Oh, if I have a storage center, I'm really not evicting families in the middle of winter, right? It's a storage center. Or if I have, a mobile home park, I'm really just leasing land, and there's very low turnover, and there's, a lot of tax advantages. So it's like, how do I move into a different area of investing that is less maintenance intensive or less management intensive, that type of thing. So I was starting to work smarter instead of harder a little bit, and but it kept bringing me back to the note piece. And once I got into the institutional notes, then it really took off because and that pretty much happened by accident.
Yeah. Well, I love that reflection process and that growth over the years. You started asking yourself those important questions of, what is the highest and best use of my time? And, in the beginning when I was, back by my first property, I was like, I'll do it. I'll buy it, no matter what. And then all of a sudden you're like, well, it's probably not worth managing that type of tenant. But, you're growing as an investor and, learning from, your experiences. And I love your natural progression of capital from, credit cards, line of credit, HELOC, hard money to private money. So what's your favorite source of capital to use and why?
Well, today all the capital we use primarily is private equity. Mm-hmm. And the beauty of private equity, not that I won't use institutional capital. In fact, I have someone right now that is coming at me with institutional capital for $40 million, right? Mm-hmm. And it's an attractive rate, but there's all these strings attached, and the one thing that I love about having a grassroots organic group of capital that is built on trust and relationship and track record, it's priceless, because if the institutional capital decides to go away or pull their plug or whatever, I'm not left hanging. And I think I like the idea of having multiple sources of capital and modeling myself off a blended rate, as opposed to, I want to get all institutional capital, or the opposite, where I want to use all private capital that might be a little more expensive. So I think having multiple sources of capital is wise, just like having multiple contractors is wise. I was from the school, because I was a contractor and worked 22 years in construction, I knew it was smart to have 4 plumbers instead of 1, 4 electricians instead of 1. Yeah. A couple drywall guys, a couple tile guys, because I know what trades are rare and hard to get, like a stonemason's impossible to get, right? So it's like, you got to know that, or you're really going to be left hanging in your project, right? So it's the same idea in all aspects. You want to have, multiple sources of capital, I think. And for me, the private equity's been phenomenal, and we can almost raise unlimited capital today. Now the key is, can you deploy it and can you execute on it? So every business has the same 3, I call it the pillars, and one of them's always highlighted at any given point in time. So it's always scalability, it's sources of capital and sources of product, no matter what your business is. And then at some point, your business could shut down, right? So if I said to you, how many notes could you handle if the notes were free? Well, at some point, it's a scalability question, right? Your business would shut down at some point. How many rehabs could you do a month? Is it 5, 10? Is it 25? Is it 50? At some point, you're shutting down, So you have to manage your capital and manage your deployment and manage your execution all at the same time.
Yeah. No, that's really smart. So let's talk about that, when financing dries up. I think you touched on it perfectly in the book. You had 3 parts. When the unsecured notes to purchase a property dried up, and then you went to part 2, using secured notes, HELOCs, and then part 3, when it dries up, using private money and hard money. So can you talk about the pitfalls of, using unsecured capital and, some of the pitfalls of using HELOCs?
Well, right. There's advantages and disadvantages to everything. You just want to be aware of them and, have the proper reserves or have the proper strategy when you're utilizing it, right? I remember, just like credit cards, for example, I'll never forget telling my wife, hey, I'm going to buy a house with credit cards. And she's like, are you freaking crazy? And
she's still with you, right?
She's still with me, actually. And she's like, that's not going to affect my credit card for the mall, is it? I'm like, no, we can still, that's a different credit card. Don't worry about that. But when you really think about it, what was the risk? If I bought a house with a credit card and something went awry, what could they do? They could take my credit card. Okay. They really would have to struggle to get to the house even.
Yeah.
Now, once I refinanced it, and usually I wouldn't refinance it until it's fully renovated with a tenant and a nice signed 1-year lease in hand, right? So now I have it up and running, and what's the risk on the bank? They're lending me, 65% usually of the after repaired value. Well, that's a lot of equity in that property, and if I'm still cash flowing a couple hundred a month, it's a pretty safe deal for the bank, pretty safe deal for me. Credit cards were paid back. What do you think the credit card companies did? They upped my limits. At one point, I had $400,000 in credit cards, which back, years ago was a lot of money for me. Now, if you're in New York City, $400,000 is a joker today, probably. But back then, it was a lot of money, and I could do a lot with $400,000. I could almost go buy anything I wanted. So when it came to HELOCs, I think there's different risks, right? Especially if it's a HELOC on your primary residence versus your rental property, for example. And I made the mistake, well, I call it a mistake. It's really not that big of a mistake, but I would use the home equity line of credit to go do other real estate projects at first. And I was like, well, it's a cheap interest rate. I could borrow this money at 3% and 4%. And, I'm a contractor. But what do you think happened when I did that? I would go buy a house over here, with 3% money or 4% money. And then I got busy in my day job over here, being a contractor or being a realtor. And when do you think I showed up for my house? Well, it's cheap money. I'll get there whenever I feel like it. So that's one issue. But the real issue was what happened to my plumber. And I tell the story in the book. I have a really good friend, a high school buddy. He was my plumber for years. And he had a nice home, $1 million house, wife and 2 kids. And he ends up, he bought a property to renovate with his line of credit from his primary, and he took a heart attack. And he was out of work 9 months. Well, he almost lost the house he lived in over this little rehab project, all to save interest rate, all to save a little bit of money on interest. And think about it. You're only borrowing the money for 6 months or whatever to renovate the house. It's very nominal. If my plumber buddy had used private or hard money, he could have just returned the deed over to the person and said, I'm sick, I can't handle this project, take back the property. And it probably wouldn't even have impacted his credit because most private money doesn't even report to credit. And he would have never jeopardized his primary residence. So that taught me a valuable lesson that it's not about the interest rate. It's about the safety as well. It's about risk. And nobody weighs the risk. They're just so focused on interest rate, they're ignoring the risk. And I was guilty of that myself. So the lesson there was, it actually came out to be a great lesson because I was like, well, this makes a perfect sense. If I go to do my own rehab project, I'm going to use private money and pay a little higher rate. And you know what? The little higher rate, it's short-term money. It's not that big a deal. And it's going to force me to get over there and get the project done. Meanwhile, my money, because I'm borrowing on a home equity line of credit, I'm going to either use short-term investments or investments that are liquid so that I don't run into any risk like my plumber buddy did. So what happened there is I started using my money for short-term private money deals for rehabbers, or I would buy notes. And the reason I would invest in notes is because I can sell a note in about 15 minutes. I can't sell a property in 15 minutes. So if there's any interest rate fluctuation in my line of credit, I can always sell a note, right? Or all my money is not tied up in one project. Say I have $100,000. Well, I might go buy 4 notes or 5 notes with that, as opposed to one rehab deal that I'm working on. So that I'm stuck in, Now, if I got hurt or anything, it's a lot different selling a note or just, I probably wouldn't even have to sell the note, but they're very liquid, right? But you can also do twice as many deals now. Now I'm doing the rehab project and I'm investing in notes. So I'm making arbitrage money over here and I'm also making rehab money over there. It's well worth the extra little small incremental cost of interest that I'm deducting for the rehab project to do twice as many deals and really build wealth. So a blessing came out of that,
Yeah, definitely. I know that was the case when I was first starting out. My first, REO purchase, I had to use a HELOC on my primary because no one saw that track record or, didn't really believe in the final product. But, I leveraged it. I was like, you know what, just like you in the first, it's like, whatever that costs it, whatever, I see it, I had that construction background just like you doing the rehabs myself. And, I found the risk, worth taking. But now, my fiance and myself, we share a primary residence, and it's like we have some capital there, and I'm like, asking myself that same question. So I think your wisdom, not only, helps, because I'm always asking that, especially when I talk to people like yourself. It's like, okay, what's your experience and what's your wisdom, at my point, and trying to gain that reflection process.
It's really simple. Borrow the money from your buddy's HELOC, and he can borrow the money from your HELOC. And now you just eliminated the risk almost, Okay. So, and if you had, say you had children now, so it's a bigger risk now because it's your primary residence, especially. Now on a rental property, it's a little bit different, but I still even play that same risk card the same way. I use my lines of credit for notes and lending, and I use other people's money for my rehab projects. I'm doing twice as many deals and happier for it. And I think I have a lot less risk. Yeah.
Awesome. Now, I love your rules for private financing. So I broke it out 3 steps. So find your rhythm, prove yourself, and build trust. So can you talk about, finding your rhythm? What does that look like?
In what context are you talking about? You mean as far as lending or rehabbing or?
Yeah, kind of, your niche for real estate investing is that your rhythm is you're buy and hold or you're fix and flip.
Finding what you're good at and what you like and what works for you at a given time. Well, some of that'll change over time, right? Like some of my strategy, most of my life I was in accumulation mode. So my rhythm was to acquire, buy and hold properties. And I looked at it as a surefire way to, build wealth. And here's the way I look at it. If you and I had the same exact job and the same pay, and you didn't invest any money at all in real estate, you just went to work and worked in your day job, bought your primary residence. By retirement, you paid it off, and that's it, right? But you're really not cash flowing from that. Me, on the other hand, I went out and accumulated buy and hold property over a long period of time. We both made the same money. The only difference is the money you paid in taxes, I was able to hold on to through my properties, through depreciation. So the only difference is I built a portfolio of properties by retirement and you didn't. And I built the portfolio in reality with tax saving dollars that over those years. That's really what's happening out there. Because I was an accounting major in college, right? I didn't become an accountant, but that's the one lesson I learned is the people that don't invest in real estate, that's what they're missing. They're missing that all their tax dollars that they don't really notice that come out of their check, they have no way of investing that or anything. But the people that buy rental properties, really what they're doing is diverting their tax dollars into that portfolio, and their tax dollars are buying the portfolio for their estate. That's really what's happening.
Yeah, no, it's extremely wise. I love Jim Rome, and he had a question. It's like, how can you afford not to invest at some point? I know I butchered it a little bit, but it's, I always ask myself, what does it look like if I don't invest? Because people always talk about the risks as a landlord and what if you get a bad tenant, but what's the opposite side of the spectrum? So
it's the other 95% of the people. I mean, I look at the tax component as there's 4 main areas that really contributed to my wealth building. One of them was tax savings, right? And just from a general sense, there's really 3 areas that we're rewarded for. And it's for providing housing, providing jobs, or charity. So if you can incorporate that into your activity, we're all on this planet for a certain period of time. I'll give you an example. Even in your real estate, like I have a buddy that his nonprofit has 39 apartments to disabled veterans, and he makes $30,000 a month doing it. Well, that's kind of incorporating it all into that model. He's taking advantage of the tax structure. Most people don't do that. They just go, it's just like the financing thing I was talking about earlier. They do the same thing with taxes. They just ignore them. They just, it's out of my check. I ignore it. They take care of it. It's too complicated. I don't want to learn it. I'd rather watch ping pong on TV or something. So that's kind of what happens. But the tax component, every dollar you save in taxes is another dollar to invest. And then when you don't have a lot of dollars, like I didn't back in the day, it was critical that every dollar I saved in taxes. And there were a couple of pieces that did that. One of the second of the four was to invest intentionally, and that included your primary residence. So that I treated property I owned in my own name or my primary residence as one investing bucket. And for most people, they buy a house, they sell a house, they buy a house, they sell a house. And then by age 45 to 55, if they're doing well, their accountant's saying, oh, you need to go buy a vacation home or a duplex. But the terms of the financing are much less desirable when they had already owned one or two or three properties along the way, that if they invested intentionally in their primary residence early on, like say they bought the first townhouse where the payment was just a little bit under rent or something, or they bought a condo or a duplex, so much smarter. And then to keep that property. You know, I bought my first property in 79, which was a duplex. I still own that thing. That thing's a cash cow.
Awesome.
So I think people lose sight of that. I literally have one property today that was a former primary residence that I run a business through today. I can live off that one thing. And all my other income and investments is just there to invest with. I literally live off one project. So I think people lose sight of that potential. And I think they throw away the settlement cost money. They don't look at that. They just look at monthly payment. It's almost like a car dealer where it's like, what do you want your car payment to be? You know, you're not looking about your down payment and how much it depreciated, or no, don't pay attention to that. Just look at your monthly payment, right?
Yeah.
So it's the same idea with houses, and people forget about, I spent 10, 20, 30 grand in closing that went out the window the day I bought that property. And when you move on to the next house, you threw all that away. Whereas if you kept it, now not only did you keep your settlement money invested, you actually grabbed a bunch of write-offs. So now you have mortgage interest from 2 properties or 3 properties, and depreciation and all the other things that go along with it. Plus, if you live there 5 years or something in your first property, well, that's 5 years towards paying off that 30-year mortgage or whatever that was, you know?
Mm-hmm. Yeah, I love your buying purposely on that first one, and you gave the best note you can get is that FHA, owner occupied 2 to 4 unit, and that's the best strategy I think. Starting out, definitely.
Yeah.
And then you had this common strategy in the book that you said you learned from one of your mentors, and you wish that someone broke it down for you sooner. And here's the quote: "So once you positively cash flow after you have all your initial capital back, or if you have no capital in the deal to begin with, you have an infinite rate of return." So then you go into the 6 steps: finding the project, raising the private equity, putting an expert team together, obtaining 70 to 80% commercial loan, purchase, improve, then refi, then repeat. So is this the formula you still use today when you're looking at projects?
Yeah. I mean, you have to. I look at what are my exits. For a while after the crash, too, one of the exits went away, which was refinance and rent. It was much harder to do that after the crash. And it was another reason I drifted into the note space, because the financing had gone away. So think about the typical real estate investor before 2008. He could buy a project, renovate it, and he had 2 choices. I could refinance and rent it, or I could sell it and flip it out. The trouble with flipping is you get slammed with taxes pretty good. Mm-hmm. So a lot of times what I would do is I would sell a property that was in my portfolio that was an older property that I had taken a lot of the depreciation. And the newly renovated property, I'd add that, a little feather in my cap to my portfolio and get rid of one of my older places or something, or less desirable. So a lot of people, I don't know that they do that. They haven't had property that long. I understand that. But the option that went away was the ability to refinance and rent. When financing got tight there for a while, that option left the table and you're forced to sell. Well, what if you couldn't sell and you use private or hard money? That's expensive money. That's a gamble that I didn't like taking very much. So, and you're in a down market for like 10 years, especially in a lot of parts of the country. We were pretty, stabilized. We weren't going anywhere as far as appreciation. So I was like, you know what? I'm going to play in the distressed debt space while that's going on. Now I'm actually back into, there's appreciation again. I'm looking at properties. I'm looking at REO. I'm looking at fixing things up. So you need to adjust with the market as well. But I don't like when options are taken off the table. Now you're starting to see options reappear now. You're starting to see home equity loans reappear. You're starting to see more favorable financing start to reappear. So it's a finance-driven business. And if you're like, oh, I'm not aware of that, I want to do business the way I always did it. Well, guess what? It's changing all around you. And if you're not paying attention, you're basically going to get punched in the head at some point.
Yeah. Yep.
When you realize my old model's not really working, is it? You know?
Yep. No, I love that, especially since you've been around for multiple markets, that how you kind of go with and work with the market and see what strategies, you talked about having an arsenal on your tool belt. And I think that's, if you can just understand that and have that just in case, maybe it's not buying and holding, maybe you just wholesale it because it's not worth your time, or, maybe you provide the debt for it for someone else who wants to do the work. And that what's really opened, my outlook is, I hear note investing, I hear, the seminars, but until I read your book and I was like, oh, so that's how it's done. Oh, okay. So, and now I'm thinking of different strategies, and it gets my, creative process going. So it's just awesome. Yeah, so I know I was just super excited. So the debt versus equity. So you say debt, borrowing money, not giving up ownership, and then equity is, giving, shares of a common stock to an investor. And you gave the example of, borrowing private capital where, you did a deal that, you gave away equity, 50-50 on the back end, or you take debt. So is that deal by deal structure, or is that, something you kind of look at, ahead of time saying, hey, I'm in a position where I can just give debt as opposed to equity?
It's a great question, and there's no one size fits all, unfortunately. So the real answer is debt and equity have a place, and there's times when both are useful, and there's wise ways to say that 10 times, wise ways to utilize them. So it's so let's take debt, for example. If I'm buying an apartment complex, well, traditional financing can really get their mind around that, and they can buy into that. And they're really, that's easy to go get bank financing for an apartment complex or something. So it makes total sense to do that and raise private equity for the down payment or renovation cost or closing cost. That's a great way to, finance that type of project. Now, there's a lot of projects that banks don't like to lend on. So then private equity makes more sense. Perfect example is we started out with delinquent second mortgages, and then eventually ended up in delinquent second mortgages with no equity and bankruptcy. Well, who's going to invest in that? A bank we couldn't make money on it, so how can you? That's their attitude. So they're not going to lend on delinquent seconds with partial or no equity. Whereas they will lend on first mortgages with equity, for example. They would give us debt financing for that. Now, there might be strings attached where they want appraisals or something like that. But my point is there's times when debt makes sense and there's times when debt doesn't make as much sense. But debt is paid ahead of equity, and it's something that you need to be aware of. And a lot of times equity investors don't like when a particular fund or a particular entity is taking on a lot of debt. Because they know debt gets paid ahead of them, right? But there's also advantages where I give an example in the book where I was actually going to be partners with my cousin, and he's a great guy. And we were going to be, at one point, do we become 50-50 partners in this project, or do I just borrow the money from you? And most of the time with smaller real estate rehab projects, capital is only worth points. And by that, I mean it's only worth the interest you pay for it. It's not necessarily worth half the deal or something, especially if you found the deal, you're renovating the deal. They're really not entitled to that unless they're doing a lot of other activity and you formed an entity and you have roles and responsibilities well defined and everybody's paid for the roles and responsibilities, or their ownership is proportionately divided based on the value they bring to the organization. Most of these structures from the small-time real estate investor are not set up like that. So, especially in the beginning, right? They're all like, hey, we're all friends. The three guys get together. Let's go, or you'll see it. I had 4 friends that bought a vacation home, 4 couples. Well, that's like a disaster waiting to happen because somebody's going to get divorced. Somebody's going to pass away. Somebody's going to, it's just going to be who gets what weekend. You're just asking for trouble with that kind of thing.
Well, speaking on partnerships, I think chapter 9 was probably one of my favorite when you're talking about your case study on that mobile home park in Michigan. And I was hooked to that story, just paragraph by paragraph. I'm like, wow, this thing sounds amazing. And that last paragraph hit me like a rock. So I'll paint the picture for the audience. So 664 units, cash flow of 591, 252, purchase price at 20.5 million. You need 4.5 million to close. So you go to your investors and you need a minimum investment of 250K each. So that, equity deal. So you're giving away 80% of the ownership to investors who invest in shares of the LLC that owns the property. You and your partners are the managing entity and retain 20% for putting the deal together and running it. So you have some creative goals, bring the cash flow up to 1.1 million by year 3, raise value by increasing rents, decreasing vacancy, expanding the park to an additional 60 spots, add pet late fees, better insurance rate. And here I am. I'm like, oh, Dave's going to make so much money off this. Cash out year 5, you're returning 60 to 100% initial capital. And then you talk about creating additional profit centers, going vertical. But that last paragraph, and you explain how it just fell apart, costing you $250,000, years of your time, damaged reputation, friends, colleagues, lost money. But the most important part, I think, is that reflection process that you have. Otherwise, you still wouldn't be around. And you said, not every deal can be a home run, but I learned pretty quickly that it's important to understand why and learn from it. You didn't run and hide. You chose to be upfront and transparent. So what went wrong, and what can you teach the listeners about your reflection process? And I'm sorry if that stings for you. So
No, not at all. I mean, failures are probably more important to talk about than successes, right? I mean,
yeah.
So, well, first of all, I do want to state this. I was not a managing partner. Okay. I actually worked for the company, and I was in their investor relations department, and I was raising capital. But I was also a passive investor and put money together. I actually formed my own entity to go raise capital to invest in this entity. So I was so involved and so close to it that I believed in it that much that I went out and formed an entity to be one of the passive investors in the entity. But I wasn't a managing partner, although I kind of headed up a pretty large investment group and would actually travel out there, go to the parks, go to all their meetings, went to closings. So I became very, was kind of vetting the deal all the way through. Yeah. The deal was phenomenal. There was no question about it. I mean, on paper, this was a phenomenal deal. The numbers worked. Everything was great as far as that went. And really what it amounted to was that there was 3 partners, and they were doing this project, the mobile home parks, the storage centers. The goal of they had a purpose that was bigger than them, and they were building a Christian academy back in New Jersey. And so it wasn't just about that. But the one partner was like almost like a home inspector type guy, and he was a construction guy. So when they were renovating the school back home, the 2 guys cut him out of the renovation project, and they brought in somebody else to renovate the school. Well, that guy got all upset because the other 2 guys were making money off the parks. They were making money, through their salaries and things, equity. And his thing was, well, I wanted to make money on this construction project of the school, and you cut me out of that. So he basically decided, well, I'm gonna destroy this project. And that's basically what happened. It was over ego. So you had a perfectly viable project where everything, the numbers worked, the cash flow worked, the financing worked, the properties were great, the management team was great. I know it's hard to fathom. But basically it was these 2 guys against the 1 guy and getting in this dispute, and it was really over ego of them cutting out the 1 guy. And, it's really knowing who your partners are and how, that can actually destroy the business. And then they didn't address it properly. They didn't handle it properly. They didn't buy them out properly or whatever. If they wanted to, I guess there's better ways to handle those types of situations, I think. But would I have, looking back, even in these types of scenarios where, there was a lot of, I went out and hired attorneys, trying to protect investor capital, doing all kinds of things, staying transparent. And this went on for several years. But the irony there is, would I have changed anything or done it differently, and I don't think I would have. I think I would have still done that project. If I saw a project like that today, sure, I might have done more due diligence on the partners, or well, the one lesson was I didn't have control. Okay. If a project that size that I'm that committed to, that I'm putting in that much capital, I need some type of control myself, And I think that was the missing link. I didn't have control over the project, where I could dictate or help to, determine the outcome of, any project can go south though. I was also involved in another project that was a land development deal that probably went on for 10 years, and it was a great project. The team was impeccable, 30-year track record, these guys, but the market killed them. So you couldn't get financing to finish the project unless you were 60% rented or sold. Well, there was no financing at 2008. It just dried up. The project was phenomenal. Everything worked out. Everything was all teed up, and then the house of cards just came tumbling down due to the market. Had nothing to do with the team or the project itself. So that's investing. I mean, that can happen. I mean, you can't. The best thing is to not have all your eggs in one basket, and to, be diversified into multiple things. And I'm still here. There's no question about it. That one was sort of a blip on the radar. But if that same project came across my desk today, I could see me going, no, that's a viable project. That's a great team. It's a great investment group. There's no reason to not invest in that. And it was really a function of, you couldn't really, could you predict that the commercial real estate market was going to tank quickly after the residential did,
Yeah. Now I'm building those relationships, and when you partner with other people on deals, is there some type of process you like to go through? We have to have a solid relationship for 6 months, 12 months. I've got to see your track record, you see mine, see if we have a fit. Is that kind of?
Well, what I do today is probably similar to that, but it's a little bit of cheating, so to speak. Not cheating, expediting it, right? Yeah. So I run an investment group today of high net worth investors that I put together. It's called Strategic Investor Alliance, and it's an invite-only group. And you might go, well, why did you create this group? I did it for two reasons. One was selfish interest, and I'll get to that in a minute. And then one was to add value to my high net worth investors that invest with me. So how could I give them additional value? And what I noticed when I did financial planning, I used to sell insurance, back when I was selling real estate, I would sell insurance too. And I saw where family offices would actually, they're typically 200 million and up. They had their own investment committee. They had their own board of advisors, that type of thing. Whereas the smaller millionaire, under 25 million, for example, they're all fragmented and they're not on the same page. Where, like, my wife's not in touch with my accountant or my insurance agent or my broker or you get the idea. It's all fragmented. So what I decided to do was, no, I'm going to form a group, and the group will act like Yelp for investment and for advisors of alternative investments. So it's kind of like a group of, it's almost like a mini mutual fund of alternative investments, and it's invite only. And it's high net worth investors. So I initially started the group with a self-directed IRA custodian buddy of mine, me, and a securities attorney, and an accountant, and a financial planner. And we brought all our networks together, and we started bringing in different investment vehicles. Now, one of the reasons I did that, for the selfish reason that I was talking about, is, for example, my self-directed retirement account or qualified plans can invest in PPR because I'm a principal. So I'm always looking for alternative investments myself. But what better way to vet them than to have the group do it? So one way is I have this group do it. So, and it's also a great way, like, say you wanted to invest in my fund and you said, Dave, I'd like to talk to people that are already in your fund. Well, it's a private offering. I can't really give out names and phone numbers. And what if you were an investor and some bozo's calling you up and you're like, who's this? Who gave out my number? Yeah. But I can invite you to a meeting where we all attend. I'll tell you what, I'll invite you to one of our meetings and explain what the meeting's about. And there's no selling, no pitching, just information.
Awesome.
So what's cool about that is it does a couple things. And you can come and network with other investors that are in my fund, but you can also diversify your portfolio, because even when I look at some of my larger investors who have significant resources tied up with my company, it might not be prudent for them to keep giving me more and more capital. It might make more sense for them to invest in some other channels just for their own safety, you know? So, and I'm the same way, right? So it's a different approach, right? But I think people will really appreciate what I've put together. And, you know, it's a great way to vet other investments. Now, I do take it a step further today. I actually have a couple resources that I use to vet different investment vehicles. So some investment vehicles, you know, PPR is kind of a little bit of a fund of funds. So if there's an investment vehicle that matches our core values and our type of business, you know, say it's some other type of vertical, I don't know, say it's tax liens or commercial notes or something like that, that's kind of in our wheelhouse as a company, well, we could vet that further. Does the company want to invest in some of that? Or do I want to refer somebody to some of these investment vehicles? So I want to do a little bit of extra vetting on, you know, whoever that is, for example. But there are some of the ways that I do it. And there's actually companies out there that will vet for you for a fee if you wanted to expedite it or speed things up.
Awesome. I love how you created that, though. You know, I feel like you get to a certain point in investing where you kind of, you know, to this point of like a financial advisor, you know, just by second chance, just, you know, understanding investments. Yeah, exactly. But yeah.
No, well, the good part about accredited investors, they're all big boys and girls, right? They're well aware that the SEC doesn't, I don't want to say doesn't care about them. They do. But when you're an accredited investor, high net worth person, the SEC is not really there to protect you. They figure you're a big boy or girl. You're responsible for yourself. You should vet your own projects, which they're correct. You should. But I think if you're, you know, diversified enough, you know, you can spread the risk around. And the beauty about the internet today is the word of mouth thing, the Yelp factor, I call it, where, you know, if you're going to a restaurant, well, why go somewhere where there's bad food or bad service? There's no reason to do that anymore. You know, there's no reason to settle today. So,
yeah, especially with the online forums. I love, you know, looking up, you know, a speaker, and you could tell right there that there's forums of, hey, they pitch you for 2 hours. And I'm like, oh, well, that saved me some time. Yeah. So I just have a few last questions.
Sure.
So what would you do differently today as a real estate investor? And what is your big, hairy, audacious goal today?
Oh, wow. So what would I do different? Probably the biggest thing is thinking bigger sooner is one of them. And an easy example of that was there was a time when I was this Remax agent and, you know, I had these multiple verticals, for example, and I was selling about 75 houses a year to real estate investors. And one of the things I looked back at was, like, I didn't really believe in hard money. I was like, hard money is expensive. I don't know why people utilize that, right? So one day I'm at lunch with a buddy of mine, and he had used hard money from some, you know, a person we both know for his first 39 deals. So I'm out to lunch with him. I'm like, dude, what would possess you to use hard money for your first 39 deals? And he goes, well, you don't understand. It got easier over time. He reduced my rates over time. It just became easy, and I just kept doing it, and it was convenient. He goes, but the real reason was I was making money on the draw. And I go, making money on the draw? What does that mean? And he goes, well, if the next phase of the project was 10 grand and me and my Cracker Jack crew got it done for 6 grand, I was able to put 4 grand in my pocket tax free. And when I went to refinance, the bank saw the 10 grand. And the takeout financing was not reduced. It was at the full amount of the original hard money loan. And I was like, that's fascinating. And I'm like, why didn't I think of that? I never knew people made money on the draw. And I discounted hard money all those years, for example. So go back to my story, right? I'm selling 75 houses a year to all these other real estate investors. I had the contractors, I had the money, I had the deals, and I gave all the deals away for commission.
Yep.
When in reality, I could have kept all the deals. And today I have a buddy out of Memphis who owns 1,500 houses, right? And I look at him, I'm like, how the heck did he get to 1,500 houses? I don't know that what made him do that. He's probably listening. Why are you talking about me like this? No, but which is crazy. Today I'd rather have 1,500 loans, right? We have over 7,000 mortgages, right? So, but the interesting thing was, okay, that's how he did it, because he he didn't give it all away. I gave it all away. And I'm looking back going, yeah, I'm worried about the title. I'm worried about the mortgage business. I'm worried about the property management. Well, I could have had all that.
Mm-hmm.
And I could have kept them all, and I could have renovated them all, and I could have used commercial financing and a commercial blanket, and I could have used hard money, especially if I could have made money on the draw, and I could have, I was short-sighted. I was like basically stepping over dollars to pick up, pennies, so to speak.
Yeah.
When I was just focused in my commission world, I was missing the big picture. The rehabbers making 30 or 50 grand on the deal, and I'm making two. But it's one thing to say, I had all the pieces there. I had all the tools in the toolbox. I wasn't taking them out of the toolbox. I wasn't thinking big enough. And I guess sometimes we're afraid to think big or afraid of success or something, I guess maybe that was part of it. I don't know. So that's the one piece. So what was the second part of the question? You said
your big
BHAG, right?
Yeah.
Well, today our BHAG is to, definitely a bigger purpose today. We're very successful. We're trying to get to $1 billion under management in less than 10 years, and I think we're going to do it. Now, that's not just the main reason. The main reason is that we're able to help other people to share, build, and preserve their wealth, and really that's what it's about. And I think, when I think of all the stakeholders that we come in contact with, whether it's our fund investors, we want to make them a nice return for their retirements because people can't make nice yields in their retirements. And we're a different way to do that without all the middlemen, without all the fees.
Yep.
Easy to invest 24 hours a day on your cell phone, right? We want to help the banks get toxic assets off their books, help their balance sheet. We want to help the homeowners stay in their homes, rework their loans, keep their houses. We had just recently moved to a new location, but in our old facilities, you would walk in the office and there were pictures of homes all over the office, and they were homes that we saved people's houses. So it was very rewarding to walk in there and go, wow, look at all the hundreds of homes we saved. So that's very powerful to help people, leave them in a better financial position.
Mm-hmm.
I was raised by a single mom with 6 kids, right? I get that. Most people in the U.S. today are probably 60 days away from bankruptcy or something. If you think about it, if you cut the paycheck off. So not a lot of savings in the average American's bank account, for most
Mm-hmm.
people. So you understand that. But I like the fact that we're able to leave people in better positions. And even note buyers, even though they might not be an accredited investor yet, they might be on their path or journey to becoming one. And if you can help them by investing in notes and mortgages, it's just another vehicle. I'm not saying it's better than any other vehicle. I never wanted to do that. I believe that there's advantages and disadvantages to all investment vehicles. And, I'll probably always own some real estate. But I do like the note piece. It's very passive. It's got its own group of advantages. And, it's definitely a place in my portfolio to have some lending going on at all times. So
definitely, yeah, awesome. And leave you the last thought. That philosophy on page 190 to 191 was absolutely amazing. I don't know if it hit a chord with me, but it just summed up the book perfectly. I always ask, like I said before, successful entrepreneurs, what's your best advice? And like you said, it's a hard question to answer, but those 2 pages really hit the nail on the head. And it's just phenomenal. And there's so much stuff that's in that book that, you can't even cover in an hour. But, I just want to thank you so much, for being on the show and, for listeners out there, like I said, we only touched on small stuff. So, the book just came out. So make sure you get your copy today. And that cover is amazing. We're talking about. So you worked on that with your son, you were saying?
No, actually, the cover came through Bigger Pockets group that helped me publish this. But, if you go to biggerpockets.com/note investing, not to be salesy, but there is some pretty good bonuses on there if you order the book through Bigger Pockets. So
definitely.
You get some extra perks, right?
Yep. Just want to give a huge thank you to Dave Van Horn. He did a wonderful job writing the book on note investing. Make sure you get your copy today. Be sure to check us out on Facebook, the Book Club Interview, and we'll see you next time. Thanks for tuning in.